Your credit score is one of the most important aspects of your financial health, but it's also one of the most fragile. Building a great credit score can take years, but damaging it seems like it can happen overnight. This can occur from late payments, collections, bankruptcies, or even errors. Thankfully, with the right credit repair strategies, you can reclaim this pillar of your financial strength. Knowing how to repair your credit can get you back on track and put the days of less than great credit behind you. Here are 7 steps to fix your credit. Step 1. Check your credit score and credit report. The first step in the credit score repair process is to understand where you're at, where you need to be, and what goes into your credit score. Your credit report contains information about how you've used credit in the past 10 years. Begin by obtaining copies of your credit reports from all 3 major credit bureaus: Equifax, Experian, and TransUnion. You're entitled to free weekly reports from each of these 3 major credit bureaus at annualcreditreport.com. Simply fill out the online form and request your reports. Note, however, that the free credit reports you can pull from this site will not contain your credit scores. You may be able to access your score for free through your credit card account or bank account, or as a perk with other subscriptions. Otherwise, you may need to pay to see where your score stands. At a minimum, plan on reviewing these reports annually. Most creditors report to all 3, but not all, so it's worth checking the information on all 3 bureaus' reports. This is important because you'll be able to see all of the accounts in your name, your credit history, and your oldest line of credit. Next, it's important to know what your credit score is. The average credit score in the US is 714. Most lenders use FICO scores for credit ratings. FICO scores range from 850, which is a perfect score, to 300. A poor score is one that falls below the 580 range. The credit reports are what credit scoring companies use to generate your score. Step 2. Review your credit reports. Once you have your credit reports, it's time to review them carefully. Unfortunately, credit bureaus do make errors sometimes. According to a study by the Federal Trade Commission, 25% of people had errors on their credit report, and 5% of people had errors that could have made it more costly to get a loan. There are certain common mistakes to look for in your credit reports according to the Consumer Protection Finance Bureau. These mistakes include incorrect identity information such as the wrong name, phone number, or address, accounts that belong to another person with the same or similar name to you, fraudulent accounts that are the result of identity theft, closed accounts such as credit cards or car loans that are still being reported as open, incorrect, late, or delinquent status on accounts, repeated listings of the same debt, and incorrect current balance or incorrect credit limits. It's important to note that open credit accounts and accounts closed for up to 10 years appear on your credit report. Look for accounts you don't recognize, payments inaccurately reported as late, and other potential errors. These include your name and any variations, birth date, current and past addresses, and employers. Credit inquiries occur when a company or individual accesses your credit report. Hard inquiries are reported when you apply for credit. A hard inquiry you don't recognize could indicate fraud. Reviewing your credit report from each of the 3 major credit bureaus often helps you spot problems. If you find mistakes on your credit report, be sure to report them to the credit bureau immediately. Negative information can impact your credit score. Step 3. Dispute errors. Inaccurate negative information, even if it's just a late payment that was actually paid on time, could lower your credit score. Errors in personal information, such as name or address reported incorrectly by a creditor, won't affect your credit score, but should still be corrected. If you find any errors on your credit reports, don't panic. You have the right to dispute these errors with the 3 credit bureaus. You can do this online, by phone, or by sending a letter to the bureaus explaining the inaccuracies and providing any supporting documentation. Credit bureaus are required by the Fair Credit Reporting Act law to investigate your disputes within 30 days. Each credit bureau has its own process for handling disputes, so be sure to follow their instructions carefully. Step 4. Maintain a low credit utilization rate. Your credit utilization rate or ratio is measured by comparing your credit card balances to your overall credit card limit. A ratio of less than 30% and greater than 0% is generally considered good. This rate measures how much revolving credit you're using compared to your total credit limits. Credit utilization accounts for up to 30% of your credit score. The lower your credit utilization, the better. Lenders use this ratio to evaluate how well you manage your finances. As an example, let's say you have 2 credit cards with individual credit limits of $2,000 each and $500 of unpaid balances on one card. Your credit utilization ratio would be 12.5%. In this case, the total debt you owe of $500 divided by your total credit limit of $4,000. Calculate your utilization rate by dividing your total credit card balances by your total credit limits. Do this for each card you hold and for the total of all your credit cards. If your utilization rate is 30% or more overall or on a single account, pay down the higher credit card balances to potentially boost your credit scores quickly. Getting your credit utilization rate below 10% has the biggest positive impact on credit scores. Step 5. Build positive credit history. While you're working on removing negative items, it's important to build a positive credit history. This step is crucial because lenders want to see a track record of responsible credit use before extending new credit. This means making all of your payments on time, every time, including credit cards, loans, and even utilities. Payment history accounts for 35% of your FICO score, which is a significant portion of your credit score, so staying current on your bills is key. Remember, payments that are 30 days or more past due can be reported to credit bureaus as late. Because payment history is the biggest factor in your credit score, even one late payment can lower your score. Late payments stay on your credit report for up to 7 years. To avoid this, consider setting up automatic payments or use reminders to ensure you never miss a due date. Consider using your credit cards for small, regular purchases that you can pay off in full each month. This will demonstrate to lenders that you can manage credit responsibly. Having a mix of different types of credit can also help improve your credit score. This could include credit cards, installment loans such as auto loans or personal loans, and retail accounts. Be sure to only take on new credit when necessary and avoid opening too many accounts at once. Step 6. Consider credit builder tools. If you're having trouble getting approved for credit or loans, consider using credit builder tools like secured credit cards or credit builder loans. These tools can help you establish or rebuild your credit history while also improving your credit score over time. With a secured credit card, you'll make a deposit that serves as your credit limit, reducing the risk for the lender and helping you build positive credit history. To open the account, you put down a refundable security deposit with as little as a few $100s. If you don't pay your bill, the credit card issuer uses your deposit to pay it. Payments can be reported to the credit bureaus. Credit builder loans are usually for amounts of $1,000 or less with repayment terms of between 6 and 24 months. Credit builder loans work a bit differently than traditional loans. The money you borrow is kept in a savings account or certificate of deposit, while you repay the loan in fixed monthly payments. As you pay back the credit builder loan principal plus interest, your payment history is reported to the 3 major consumer credit bureaus. Making timely payments demonstrates financial responsibility and could help improve your credit score. When the loan is paid in full, you'll receive the money in your account. Step 7. Monitor your progress. And last but not least, be sure to monitor your credit regularly to track your progress. You can use one of the many free credit monitoring services such as Credit Karma, or sign up for credit monitoring through one of the credit bureaus. Monitoring your credit allows you to see how your actions are impacting your score and identify any areas for improvement. Check your credit reports regularly for any new errors or inaccuracies, and continue to work on improving your credit habits over time. Keeping a close eye on your credit can keep you from falling back into bad spending habits that undo all your hard work. Repairing and rebuilding your credit will take time and patience. Therefore, it's important to have realistic expectations and not expect quick results. Stay focused on your goals and continue practicing good credit habits. Over time, you'll see your credit score improve as a result of your efforts. Thank you for watching. Let me know in the comments which of these tips you have used to help improve your credit. Like the video and subscribe.